Melbourne. Chris, great if you're a trader in a sense. You know, this is volatility we've been praying for. It's with us. Chris, why are we talking dark days? This is all about price action and you know, a lot of kind of movement to key off.
Well, I think the glaring thing that we've got to say is there is no real clear reason why we saw such an aggressive sell-off last night. I mean, I can give you perhaps 5 or 6 key reasons, but there is not one major smoking gun. For me, one of the major situations which probably isn't being discussed from some of the research that I've read overnight is the comments from James Bullard. James Bullard said that on his metrics, what he's looking at, inflation expectations and inflation is actually going up. Which I'm not quite sure what he's looking at, to be honest, because all other Fed members are saying that inflation expectations are falling down. If you look at the bond market's break-evens, which is their way of pricing in inflation expectations, is falling, and it's fallen from about 2.1% to currently stand about 1.6% in a few months. But certainly, if you look at what James Bullard's been saying, and he also came out, and remember, he is a voter in 2016, he is fairly hawkish as well. He's not concerned with the move that he's seen in the US dollar. And I think if you look at what happened in the prior session, obviously we saw this wave of euphoria as people said that the Fed are pushing back on rate expectations. They're going to try and cap the moves in the dollar, which of course is going to be very good for the S&P because so many companies make money abroad. If you look at James Bullard's comments, and if you coincide that with the move that we saw in the interest rate market last night, it would suggest that a lot of the work that was done in the prior session was undone on those comments. So I think that's one thing. Then the major situation which everyone's talking about is obviously what's happening in European growth. The export numbers came. Export numbers came. Sorry, go on.
I was going to say you make the valid point, and it's exactly what he said. But he then, in the next breath, makes the comment, and he made this actually a week ago. So I'm trying to find sort of a consistent line of thinking from Bullard. Manufacturing jobs are coming back to the US, but not enough to drive the economy. Well, of course they won't if the dollar continues to strengthen. Why will the jobs come back?
Well, I think that's a structural issue, to be honest, Carson. And I think the other thing we've got to put into context is if the Fed were genuinely worried about the US dollar move, go back to 1985, go back to 2002, and look at the dollar move then. I mean, we've retraced, if you go back to the falls we saw in the Dixie from 2002, we've retraced about 25% of that. We've had a little bit of a spike in the dollar. If you look at it on a long-term monthly chart, we've had a little bit of a blip in the US dollar as people get a little bit excited, and we've seen major policy divergence. But if they're concerned about the dollar now, I mean, they really would be concerned if they saw the same sort of moves that we saw back in 2002 and 1985, where we saw an absolute, you know, just a huge move up. So, but I think, you know, the comments we've been seeing over the last week or so, I mean, we heard from, you know, likes of John Williams last night. We heard from Stanley Fischer. These comments are all, they're not new, they're all comments that we've heard many, many times before. The Fed are now speaking every day. We're going to hear more comments probably coming through in the next week or so from Fed officials. They're all banging the same drum and saying the same message that we've seen before. Unless someone says something radically new, we shouldn't necessarily put money to work. It's just, if you look at the volatility structures in the S&P last night, if you look at the VIX, for example, it does seem that people were really wanting to, that they probably did hear new news because we saw it up 24%. I mean, people were buying protection for this market. What they're buying protection from, you know, we're not quite sure, but it looks like if you're looking at the macro risks, you know, perhaps Bullard's comments were one thing, and we did see that move rates markets. But clearly the bigger concern now, and you heard John Williams say it, the biggest concern now is what's happening in European growth, and probably that's the story we should be talking about right now.
Yeah, well, it's sort of almost deja vu, isn't it? When have we not talked about European growth?
But let me jump in here, because what we saw in 2012 was this idea that we were seeing political concerns and Greece couldn't meet its repayments, and potentially during their election, when they couldn't actually get a government together, there was this term called, which we used before, which was Grexit, which Citigroup at the time coined about 80% probability that Greece would leave. It's the idea that the European Monetary Union would break up, and we saw low growth and loss of confidence based on that. What we're seeing now is very different, and this is, I think, what is the concern. you know, you've got German manufacturing in contraction. In fact, if you look at German manufacturing relative to that of the US manufacturing, you've seen that widest divergence since, I think, mid-2012, and, you know, that's going backwards. You've got manufacturing contraction in Austria, Greece, and a number of other countries as well. You've got deflationary aspects in a number of European countries. But the issue now is not so much with the periphery, it's the fact that the core is being clearly affected by what's happening. Maybe that's down to the fact that the sanctions that were imposed on Russia, and we heard Mr. Schäuble coming out today saying some of the risks are affecting Germany much more than other countries coming through, and you know, that would be clearly an issue that's happening with Russia at the moment. But the issue is now the core, the fact that the French came out in May 2013 and said, okay, we're seeing this stability pact that was put in place between Helmut Kohl and Francois Mitterrand many years ago, and we're just going to effectively rip up that stability pact. We're going to push back on this idea that we have to keep our deficit levels below 3%, and we're going to probably come out with a deficit to GDP levels of about 4.4%. What sort of ramifications that sends to Italy, what sort of message that sends to the periphery, I don't know. But
who intervenes? Who basically is the arbiter on this? If you just tear up rules and treaties ad hoc, who steps in?
Well, the EU.
Yeah.
The EU do.
Yeah.
The French are going to basically, and yeah, Mr. Hollande in France his popularity is falling by the day, but it's not just falling within the French public, it's falling within the European Union as well. I mean, the European Union has to sign off on the budget, and they won't. They'll reject this, and Francois Hollande will have to come back with some sort of proposition. There'll be a period of negotiations that come through. But you know, they've come out and said, well, we want to balance, we want to try and get to this 3% target by 2017. So this is not the first time. And if you're German and you're sitting there right now and going, well, we've had a balanced budget in our constitution since 2009. You're not going to be happy about this. There's the IMF are pushing Germany to try and spend more and try and help out its neighbours. But Germany don't have fiscal room to manoeuvre. They just don't have that wriggle room, and you know, it's a dark place.
Is it time for the EU to drop the Russian sanctions?
Oh, I mean, that's probably well above my pay grade, Carson, to be honest. But
I mean, as you say, Schäuble's, he's peeved, to put it mildly, and rightly so. Big trading partner.
There's no doubt about it. There's absolutely no doubt that the sanctions are crippling the Russian economy, but it's having major kickback on Europe as well. There's no doubt about it that it is absolutely, you know, killing their economy. I mean, the falls we're seeing in the energy complex is bad for European inflation numbers. I mean, if you want lower inflation, you probably want it from the energy space, because obviously if you're a net importer of oil, and that certainly is really positive for most of Asia, to be honest, because they are big net importers of oil, and their terms of trade will naturally benefit from this. But I think, there's no doubt about it, the Russian sanctions are crippling their economy. But I think what happens now is we have to get to an equilibrium where people say, well, what's actually happening now between in the Ukraine and with with the separatists, and do these sanctions really need to exist in such shape and form? But the issue is that they're getting worse. There are more sanctions being put on. It doesn't look like they're going to be unwound anytime soon.
Yeah, we're all losers now is the kind of, I suppose, conclusion from all of that. Some opening calls, Chris. Let's come back into the market.
Well, we've got the market opening down fairly heavily, down about 63 points, down about 1.1%. I think there's probably downside risk to that, if anything. I mean, if you look at where S&P futures were at 4 o'clock, you put them into relationship now, the S&P futures are down 1.9%. So we are going to, if that call is correct, outperform the lead that we've had from the S&P futures. It looks like the Nikkei is going to get hit a little bit. China will probably rally quite nicely today. That's just the way it works over there, to be honest. The equity market's on fire at the moment. But don't think that there's really going to be a sector that does well today. I mean, it's going to be chuck the baby out with the bathwater, to use a really horrible expression. But if you look at gold, people are saying, oh, gold's up. Gold's actually down from where we closed yesterday. Gold's actually down a couple of dollars. If you look at stocks like Barrick Mining, Newmont Mining, they were absolutely slammed yesterday. Gold's not going to be a safe haven for us today, even though most of the gains we saw came through in our time zone yesterday. It's priced into stocks. Iron ore's down a touch. BHP's ADR is down 1.5%. I think that's the issue. If you look at the S&P, the energy sector was taken to the woodshed last night. It was absolutely chopped up. It was it was brutal moves. The price, the message that we're seeing at the moment, everyone's talking about it. you've got to look at Brent, you've got to look at WTI, both in bear markets. If you look at the 30-year US Treasury, just testing that 3% level, that's the story. If you want to see global growth and the market's pricing of global growth right now, you've got to look at Brent prices and you've got to look at the 30-year US Treasury.
Yeah.
That tells you a pretty clear picture.
Then again, they did have that sizable bond auction in the 30-year overnight, so you know that's going to have had an influence on the price action.
Yeah, but there's been bond auctions all week, and you know, if you go back to the beginning of the week, there was a 3-year bond auction that had the biggest bid to cover in ages. I mean, the story again, I mean, we can go into the fact that everyone wants fixed income. Why would you not want fixed income at the moment when, you know, the world, they're concerns about global growth, which are really being driven by what's happening in Europe. But you go to the S&P, the S&P's up about, I don't know, it's up about 5% or so for the year. The 30-year bond's up about 19% or so. So, you know, being long in fixed income has been fairly good. Well, it's been very good, actually.
BlackRock's total return fund up 6% this year. Nothing to sniff at, as you would know.
No.
We will talk to you soon.
Thanks, Carl.
Thank you so much, Chris West.